Dave says, when you do a short straddle, selling a call and selling a put, is it wise to use the sold put to cover the sold call? Or is that something that is not wise to do? First off, Dave, a short put does not cover the short call obligation. They're both naked options. Second, I should have started with this as number one. I never do short straddles or short strangles. I don't like the idea of the infinite risk to one side or the other, especially in these types of market conditions. We've had a couple discussions, one maybe or two, this year in 2022 since January 3rd, regarding short strangles and things of that nature. Hey, with volatility so high, it's so great to go so far out of the money. Use a delta of 0.2 on the short put and the short call. You've got a very high 80, 85, maybe 90% probability, so you don't have any risk. Oh, you still have risk, and the market has taught us that in these last 7 months, believe me. But no, as a direct example, the short strangle, I don't do these positions. I'm always upfront about that. And if you could talk to anyone else who's on the webinars here that has been there, they would tell you the same thing. For years, never have I traded a short straddle or a short strangle position. It's not something I do. It takes on too much risk, and management techniques are oftentimes, to me, a headache trying to repair those positions when questions come in from customers. But in general, what do I mean one does not cover the other? This is a completely uncovered position. And yes, your broker will allow you to use margin. When entering any position, when starting to study a new strategy, and Dave, I'm not saying this is a new strategy to you because you would ask questions about it and so forth, so I know you've probably been practicing and trading this for a while. What I'm doing is selling a naked put. This is an obligation, regardless if I am in a spread, if I am in a strangle or an iron condor. Anytime I sell a put, I have an obligation to potentially buy shares of stock at that price if the stock is trading below it. Obligation to buy. So in our example here, selling the 49 call and selling the 42 put, if NEM drops to $41, I may be forced to buy shares of stock at 42. At that moment, I own shares of stock at 42 that's trading at 41, and it is a covered call now with this deep out of the money 49 call that's probably worth only 1 cent at that time. But the moment that we enter this strangle, this obligation that you've entered by selling the contract cannot cover the obligation on this. And that's why the total requirement that we show here on power options, yes, we know your brokers have that combination they use. It's an equation that's, 25 or 33% of the short call strike price minus the put premium or something along those lines. See, I don't even know what that equation is because I never trade these strategies. But you do still have a full naked call and a full naked put. Yes, you can only lose on one or the other, but never expect that you're going to be assigned where you'd buy stock to where this naked call obligation is covered. You can't exercise the sold put, Dave. If the stock, let's go the reverse. Your obligation on the short call that you have entered without buying any stock is that if the stock goes up to 51 and you're assigned at 49, you have to deliver shares of stock that you don't own. You can't exercise your put that you sold. Someone has to exercise you, and no one's going to let you buy shares of stock at 42 if it's trading at 51. There's no coverage there. Once this call goes in the money, you can't do anything with it. This is just a deteriorating asset you sold. You could buy it back from 1 cent. That's it. It does not cover your obligation of the sold 49 call. So what does this obligation mean? I have to deliver shares of stock I don't own. Now the stock's at 41. You've entered into an obligation to deliver, which means if you're assigned, you're going to be short shares of stock at $49 on a stock that's trading at 51 and potentially going higher, where you could increase the loss because you're going to have to buy it at the higher strike prices in that case. Okay, so that's a short strangle. I'm honest with you, I understand it. I've had discussions on what to look for in a short strangle. As far as delta goes, probability sum is a popular filter that's used for investors using the search tool. Dave says, is it ever profitable? Well, it can be profitable in the right market conditions. The fact that I've been doing pretty well with long strangles on, say, SPY over the past 6.5 months leads me to believe that you probably would have had some headaches at least 3 or 4 times doing short strangles on SPY, even with a 0.2 or 0.3 delta over that same time period, because I was using 0.3 to 0.35 deltas and getting good profits, which means if you were on the other end and selling an out of the money short strangle with a 0.3 or 0.35 delta, you would have had to manage those sides for extreme losses where I was seeing decent profits. Okay, even with times of higher implied volatility in those cases. Yeah, Fernando. Okay, so that's let me detail this a little bit more. My comment, Fernando, before I get to your comment. I do not trade the short strangles or short straddles. I get the idea that this is a great way to generate premium on both sides, and in a neutral market, hey, I'm increasing that, and with the margin that they're allowing you with the brokers, that you don't have to put up the full naked amount for the naked call and naked put. I get all that. This is by definition, other than a short straddle, this is by definition probably the most neutral option strategies you can trade. Even though you've gone out on the wings, you don't want to see any movement in one direction or the other. You want this thing to stay right around $45 for the next 21 days as much as possible. For the protection in place, for having a position that I might enter that does the same thing, I'm going to be honest, I would look at an Iron Condor. I don't like iron butterflies. I'm going to look at an Iron Condor position, very similar to the short strangle. We're just going to buy a further out of the money put. So I'm at 42. That's 50. I want less than half. All right, I'll go 39. Much wider than I want. I'm sorry. So that's a 3-point spread here? Yeah. And I'll keep the same. I'll go to 52. So instead of taking in a premium of 104.50, I'm only going to take in a premium of $69 or $70. I've got a max risk of, where's the 5? Let me just get rid of that so it's an even number. That'll help, won't it? Perfect. 69. True risk of 231. That's still a 29% return on risk for 21 days to expiration, and I don't have an infinite risk. Yeah, I can still lose 230 per contract, but I'm looking to make about a 30% return here on the position. Again, with some hopefully reasonable probability. I'm more comfortable with this. And I'm mentioning this also because Fernando says on just a straight short strangle, if you need to cover the short options as you're nearing expiration, he says you cover the short options with the long options in early expiration, or as you get closer to that expiration day, 2 days away, 3 days away, if it's in trouble, that'll help maybe hedge it if it still keeps going against you. But in general, just as with the credit spreads we mentioned a little bit earlier, the stop rules that Victor says maybe it's not the best time to use in these more volatile markets. Maybe. I'm sorry, even on Iron Condor, I'm still using the 1% rule. So look to manage or adjust the position if the stock falls within 1% of the short put or the short call strike price. And I'll probably close the position if there's a sudden movement. The stock's here and breaks, and I'm at 50% loss of that 231 on the position. Okay. Dave, yes, you can. And okay, Fernando, I'm sorry. I'll follow up with that first. And Fernando says, just in case, let everyone know, I don't use the short strangle position. I was just commenting. Okay, Fernando, that's right. So you can, and Dave says, can I turn a short straddle into an Iron Condor to limit the risk and the margin requirement? Yes, but there's a trade-off. Okay, I'm looking at NEM here at a short strangle that's right at the money. We saw how this reduced the risk. It was 8,995, Dave, monetary requirement for just our short strangle without the other legs. Now, even with the calculation of that, whatever it is, 1/3 of the true monetary requirement of the naked call or naked put combined minus the premium, you're still probably looking at maybe $2,000 or so. Each broker is subtly different, but there is sort of a standard that's out there now on that margin requirement for a short strangle, as far as I understand. But yes, you've reduced it. But what are we not talking about here? Let's take Amazon as an example. It's close to, I think, the numbers that you used. And I think you said 125 call and one, whatever it was you were looking at. I can't remember, but I'm going to say it's a 125. I have to change the symbol. That would help, wouldn't it? All right, fantastic. So Dave, what am I talking about here? in your note, I think you had mentioned something of 127.50 or 125. I'm going to use a 127.50 and sold call, and my sold put would have been maybe closer to the 100 range, 105, let's just say, for example. Now, let's say that at that time, I'm just going to give you $1.40 for each one. So what am I talking about? I'm talking about a short strangle here. Maybe you did when Amazon, let's say, was around 115 or 114 or so. And you sold it out of the money 127.50, and you sold it out of the money 105, and we're going to give you $1.50 for each one. Okay, so the answer to your question is yes, converting it to a condor is going to free up the margin requirement and lower the maximum risk. But if I'm in a situation where the short call or short put has already been breached, and now I try to convert it to an Iron Condor, let's see where we are right now, first off, monetarily. It's just going to be easier to add it to the portfolio. July 29th, where we had our Starbucks covered call. Okay. Yes, I know the date's wrong. So, okay, what I want to show you here is that we're currently down $663 on this position. It cost us $963 at midpoint to liquidate it, and we took in a $300 net premium to begin with. So we're down $663 on this trade, or 220% from the max we expected to make if the stock was between the strike prices. Okay, now let's go back. Now that this has been breached, can I still convert this to a condor, or check the losing side, Dave, and convert it to a bear call credit spread that's still losing? Let's take a look. I've got the 127.50. I was on the August 19th expiration, I'm sorry. And we know we took in $3. So what I really like to do is buy a call that's less than $3, but that's not happening, right? I buy a 2-point spread. Let's do a 5-point spread. It's going to cost me $6. What's that going to do to the position? Now I've got a debit half condor position. Now I still have a monetary. Why is the monetary requirement so high? It's because now this is just a naked put. It's reading a naked put plus the 5-point margin for my bear call spread at 127.50 sold, 132.50 bought. The maximum risk is infinite, but the maximum risk to this side is still even to where you are if you liquidated right now. And this is because the price of the option here put this into a debit of 305. Well, how's my loss $800 up here at expiration? Because you're losing the 305 debit, and you've got to cover the 5-point loss between the bear call credit spread. So you essentially have to buy shares of stock at 132.50 and deliver them at 127. The bear call credit spread is closed. You take the 5-point loss plus the now 305 that you came in. Does it work if you go further out of the money to pay less than $3 to still keep a profitable value if and only if the stock position was between the original strike prices, at expiration as you expected? 140? Yeah, let's keep it even. Let's go 142.50. But what are we doing here? That's a 15-point spread. I still got to put up 15 points of margin. So to 127.50 to 142.50, it's a 15-point spread. I keep a net credit of 126. But I can still lose $1,300, $1,400 if it continues up in price. I'm still losing the same amount if I liquidated right now. It doesn't help mitigate the risk in that case. Excuse me, Dave. Compared to what it would be, maybe a little bit versus liquidation. Does it free up the margin? Well, keep in mind, if your broker allows you to do this, if you've already in the short strangle, that would stay, and then all you're doing is buying a call at 173.50, so there's no other additional monetary requirement. The custom spread tool here looks at it not at margin. What it's calculating here is this full risk. Again, is the 15-point bear call credit spread now, the margin you have to put up for that, Dave, plus the margin of the 105 put, or $10,500. So that's where your total margin requirement is coming from in that case on the bear call and the naked put. Okay, so those are sort of those positions there as well. What you can and can't do, what it does and doesn't do for you. Does it free up whatever the total margin would be? likely because your broker already saw it as a short strangle position. But now if they do read it as a bear call with a naked put, that might be different, or a cash secured naked put. You'd have to check with your broker. But in general, it wouldn't change the requirement in that case. What I mean by that is that you've already entered a short strangle, so now you're just buying a long call. You're just adding $175 into the position going along those lines. Does it reduce the risk in this case versus your short strangle? If the stock kept going up to 140, 145, 150, absolutely. You've set a floor to it now, but that loss is still in the $1,300 range as well. Okay, Fernando thought on that with the Iron Condors I mentioned. He says, I think to be profitable in Iron Condors, you have to mount the position in different times, but this is trading. What he means by that is doing the bull put at the right time, and then when you think the stock is peaked or it's been moving up, so you enter the bull put, it looked like a good bullish move. You're maybe 20 days out in time, maybe 10 days later, you think it's your stock or the market's hit a peak, and then you sell the bear call to get maximum, then it starts to retrace. It's possible, but it does require timing and trading, as you mentioned, Fernando. Usually when I talk of an Iron Condor, I'm putting on both legs at once, and it's usually for me, if done, only done on a broad-based market ETF or an index. I typically don't like to use Iron Condors on stocks, and this isn't even because this is 2022. I like the bull puts on stocks, but Iron Condors, I typically like to stay with a lower volatile broad-based market ETF or an index position in those cases. Not one of my favorite strategies, not something I trade that often. You've heard me say before, especially when we're talking about bull puts and the nice bull run. Those of you that have been with me since, well, we've been doing these webinars a lot longer than that. I've been power options a lot longer than that. But those of you that have been coming more to the webinars regularly in 2016, 17, 18, you've told me, and you've heard me say honestly, I haven't traded an Iron Condor directly since probably 2016, 2017. I've legged into a couple condors as a potential repair. One of our 8 ways we discussed to manage a bull put or a bear call credit spread. That's, of course, on the playlist there, the 8 ways to manage. One of the 8 is converting a bull put to an Iron Condor. I don't use it that frequently because if the stock's falling and is maybe 2% away from my short put, but I only have a few days to go, I give myself a better break even by getting 10, 15, or 20 cents by adding the bear call. But if the stock keeps falling, I didn't do anything to address the risk on the bull put side other than that 10 or 15 cents. So it's very, very infrequently would I ever use that Iron Condor method to manage a bull put spread. Sometimes it does work, and I've seen it work. I've seen it work with some of the positions our attendees to our webinars have brought to us that we've discussed as a way to manage it. But in general, to me, it's still not addressing the potential risk on the one side or the other. I want to try to address that risk on the one side or the other rather than just taking an extra 10, 20 cents in those positions. Okay.